Imagine waking up one morning to find the heart of the world's financial powerhouse, the American stock market, shaking, trembling, and plunging into chaos. What if I told you this upheaval isn't just a fleeting storm, but a direct fallout from a fierce economic clash thousands of miles away, sparked by a tariff war with India? This isn't just about numbers on a screen. It's about jobs, innovation, and the very future of global power. Today, we stand at a crossroads where decisions made in boardrooms and capitals will ripple through every American household. Let's unravel what's happening, why it matters, and where we go from here. The recent dramatic plunge in America's stock market was not a random occurrence or a simple market correction. It was directly triggered by an escalating tariff war with India, a conflict that has exposed deep vulnerabilities in the global economic system. What began as a series of retaliatory tariff increases quickly spiraled into a full-blown trade confrontation, sending shockwaves through financial markets. Investors who had grown accustomed to steady growth and relative stability found themselves suddenly confronted with uncertainty and risk on an unprecedented scale. The stock market, often seen as a barometer of economic health and confidence, reacted swiftly and severely. Major indices dropped sharply, wiping out billions in market value within days, reflecting the collective anxiety over what this conflict means for American businesses, consumers, and the broader economy. This crash is significant not just because of its scale, but because it marks a turning point in the relationship between two major global economic players, each reliant on the other in complex ways. India, as one of the fastest growing economies with a burgeoning middle class and an expanding manufacturing base, has become an increasingly important trading partner for the United States. Conversely, American companies have invested heavily in India's markets and supply chains. The imposition of tariffs disrupts this symbiotic relationship, introducing friction where there was previously cooperation. Companies that once enjoyed relatively predictable trade conditions now face new costs and barriers that threaten profit margins and growth plans. For investors, this translates into heightened uncertainty, prompting widespread sell-offs. The market reaction is further intensified by the broader implications of the tariff war. It signals a shift away from globalization's recent era of liberal trade policies and towards a more protectionist stance that risks fragmenting international markets. This disruption is particularly damaging in a world economy still recovering from the shocks of recent global crises. The stock market's sharp decline is a symptom of the fears that this trade conflict could escalate, dragging down economic growth, reducing corporate earnings, and triggering volatility across multiple sectors. From technology firms reliant on cross-border supply chains to exporters dependent on open markets, the financial fallout touches nearly every corner of the economy. Adding to the turmoil is the psychological impact on investors. Stock markets thrive on confidence that companies will deliver profits, that policies will support growth, and that international relations will remain stable. The tariff war introduces doubt into all of these assumptions. As fears grow that the conflict might persist or worsen, investors pull back from riskier assets, favoring safer havens, which further depresses equity prices. This flight to safety can create a feedback loop, accelerating market declines and increasing the difficulty of stabilizing conditions. Moreover, the timing of this crash amplifies its effect. Coming at a moment when inflationary pressures and interest rate uncertainties already weigh on the market, the tariff-induced downturn adds another layer of stress. Policymakers and market participants alike are forced to navigate a complex and volatile environment where every new tariff announcement or retaliatory measure reverberates across financial system. The resulting volatility is not only a reflection of immediate trade tensions, but also a warning of the deeper economic realignments that could follow. Ultimately, this market crash serves as a stark reminder of how interconnected and sensitive the global economy has become. The tariff war with India has transformed what might have been a contained political disagreement into a catalyst for financial instability. For investors, businesses, and governments, the challenge lies in understanding the full scope of this disruption and preparing for its long-term consequences, even as they seek ways to mitigate immediate damage. The fall in stock prices is more than just numbers on a screen. It is a clear signal that the current economic order is being tested and that the path forward will require careful navigation through uncharted territory. The impact of the tariff war between America and India extends far beyond the immediate stock market crash. It has sent powerful ripples through the global economic system, affecting everything from supply chains to investor sentiment and international partnerships. In today's interconnected world, trade conflicts do not stay confined to the countries directly involved. Instead, they create a domino effect, influencing economies and businesses across continents. As the tariffs escalate, they disrupt the delicate web of cross-border commerce that has been built up over decades, causing uncertainty and instability that reach far beyond the trading floors of Wall Street. One of the most immediate and tangible effects is on global supply chains. Modern manufacturing and trade rely on highly integrated networks that span multiple countries. Raw materials might be sourced from one region, components assembled in another, and finished goods shipped across oceans to consumers worldwide. The introduction of tariffs raises costs at several points in this chain, forcing companies to reconsider where and how they operate. For American firms that depend on Indian imports for critical components or materials, tariffs increase expenses and delay production timelines. This disrupts not only their operations, but also those of suppliers and customers further down the line. Similarly, Indian businesses face retaliatory tariffs on their exports to the U.S., limiting their market access and revenues. These disruptions strain relationships built on efficiency and trust, prompting companies to seek alternative suppliers or markets, which is costly and time-consuming. Investor confidence, which is crucial to market stability and economic growth, also takes a severe hit from this tariff war. Financial markets are forward-looking and sensitive to geopolitical risks. The escalation of tariff signals to investors that trade relations are deteriorating, creating an environment of unpredictability. This uncertainty makes investors wary of committing capital, especially to sectors directly affected by the tariffs, such as technology, manufacturing, and agriculture. As a result, stock prices fall and capital expenditures slow, reducing economic momentum. Beyond just the affected sectors, the fear of broader economic repercussions can lead to a wider withdrawal from risk assets, affecting portfolios and investment strategies globally. The tariff war also undermines the foundations of international economic partnerships that have supported growth and stability for years. The U.S. and India have cultivated ties not only in trade but also in technology collaboration, defense, and diplomacy. These ties depend on mutual trust and cooperation, which are strained when trade policies become weapons of economic warfare. The imposition of tariffs sends a message that economic interests are being prioritized in a zero-sum manner, potentially encouraging other countries to adopt similar protectionist measures. This risks triggering a cascade of retaliatory actions that could fracture the global trading system, making it harder for all nations to collaborate on pressing issues such as climate change, security, and sustainable development. Moreover, the tariffs increase the cost of goods for consumers in both countries, affecting purchasing power and potentially slowing consumer spending, which is a major driver of economic growth. When companies face higher tariffs on imports, they often pass these costs onto consumers, leading to inflationary pressures. This creates a feedback loop where consumers reduce spending, businesses face declining revenues, and the overall economy slows. The impact is felt not only by large corporations but also by small and medium-sized businesses, which may have less flexibility to absorb higher costs or navigate shifting trade rules. As these various effects cascade through the global economy, the initial tariff war between the U.S. and India becomes a catalyst for broader economic uncertainty and realignment. Countries and companies alike must reassess their strategies in a landscape where protectionism threatens to replace the open markets that have long been the engine of growth. The challenges extend well beyond stock prices, touching on the very structure of global commerce and cooperation. The tariff war between America and India is far more than a mere dispute over taxes on imported goods. It represents a profound confrontation over economic influence, technological leadership, and the future architecture of global commerce. At its core, this conflict reflects deeper strategic ambitions and competing visions for how the world economy should evolve in the 21st century. Both nations see themselves as pivotal players on the global stage, each striving to secure advantages that will ensure their prosperity, security, and influence for decades to come. The tariffs are thus a symptom of a larger rivalry rooted in geopolitics and economic power, rather than a simple trade disagreement. For America, the tariff war is part of a broader effort to protect key industries and intellectual property, maintain technological dominance, and address perceived unfair trade practices that threaten domestic jobs and innovation. The U.S. has long championed a rules-based international trade system, but now faces challenges from emerging economies that are asserting their own agendas and sometimes bending those rules. By imposing tariffs on Indian goods, American policymakers aim to press India to reform trade barriers, open markets, and strengthen protections for American businesses. However, these measures risk provoking retaliatory actions, turning economic engagement into a battleground of competing interests. India, on the other hand, views the tariff war through a lens of economic sovereignty and development priorities. As a rapidly growing economy with aspirations to become a major global manufacturing hub, India seeks to protect its fledgling industries and control the pace of foreign influence on its markets. Tariffs are used strategically to foster domestic production, shield local businesses from overwhelming foreign competition, and generate revenue for public investment. Furthermore, India's leadership frames these moves as assertions of independence, signaling to the world that it will not be pressured into compromising its development model or regulatory frameworks. This stance resonates with India's broader geopolitical ambitions to be recognized as an equal power capable of shaping global rules rather than simply following them. Technological competition is another critical dimension of this confrontation. Both the US and India are investing heavily in emerging technologies such as 5G, artificial intelligence, and digital infrastructure. Control over these technologies is seen as essential not just for economic growth, but also for national security. The tariff war exacerbates tensions by disrupting technology supply chains and complicating collaboration. Restrictions on imports and exports of critical tech components slow innovation and raise questions about the future of cooperation in research and development. The rivalry thus extends into high-tech arenas where dominance will confer significant economic and strategic advantages. This economic and strategic confrontation also highlights the shifting dynamics of global commerce. The post-World War II era was defined by the rise of a globalized economy with relatively open markets and interdependence among nations. However, the tariff war signals a move toward a more fragmented world, where countries prioritize national interests over collective gains. This shift has profound implications for global trade governance, international institutions, and multilateral agreements. It challenges the idea that economic integration automatically leads to peace and prosperity, revealing instead how trade can be weaponized to achieve geopolitical objectives. The confrontation underscores the complexities of balancing national economic priorities with the realities of global interdependence. While tariffs aim to protect domestic industries and assert economic sovereignty, they also risk undermining the global cooperation necessary for addressing transnational challenges such as climate change, supply chain resilience, and financial stability. Both America and India must navigate these tensions carefully, as their choices will influence not only their bilateral relationship but also the broader international order. This tariff war is thus a defining moment, reflecting the intersection of economic policy and geopolitical strategy in a rapidly evolving world. The immediate impacts of the tariff war between America and India have been wide-ranging and severe, touching multiple facets of the economy and triggering a cascade of challenges for businesses, consumers, and markets alike. One of the most noticeable effects is the increased volatility on trading floors. Stock markets, which often thrive on predictability and confidence, have been roiled by the uncertainty generated by escalating tariffs and retaliatory measures. Investors, unsure about the stability of trade relations and the future profitability of affected companies, have reacted by pulling back from riskier assets, resulting in sharp fluctuations in stock prices. This heightened volatility not only creates an unstable investment environment, but also complicates the ability of companies to plan and execute long-term strategies. Corporate investment decisions have also been impacted. Many companies rely on stable trade policies to justify expansion plans, new product development, and hiring. The tariff war introduces uncertainty about costs, market access, and regulatory conditions, prompting businesses to delay or scale back investments. For industries particularly exposed to the tariffs, such as manufacturing, technology, and agriculture, the stakes are especially high. Companies face higher input costs due to tariffs on imported materials and components, which squeeze profit margins. At the same time, access to key export markets is reduced by retaliatory tariffs from India, cutting into revenue potential. These dual pressures make it difficult for firms to justify capital expenditures, slowing economic growth and innovation. Exporters have been hit hard by the shrinking of markets resulting from the tariff conflict. Indian tariffs on American goods limit the competitiveness of U.S. exports, leading to reduced sales volumes and lost market share. Industries that depend heavily on exports, such as agriculture and manufacturing, find themselves particularly vulnerable. Farmers, for instance, face tariffs on crops and agricultural products, which reduce their income and disrupt supply chains. Manufacturers that export machinery, technology, or consumer goods can confront similar challenges. The loss of export opportunities also affects related sectors, including logistics, shipping, and insurance, creating a ripple effect throughout the economy. Consumers are likely to feel the impact of the tariff war through higher prices on goods. When companies face increased costs from tariffs on imported materials or retaliatory taxes on finished products, They often pass those costs along to consumers. This can lead to inflationary pressures, reducing the purchasing power of households. Price increases on everyday items, from electronics to clothing to food, can erode consumer confidence and spending, which are critical drivers of economic growth. In some cases, consumers may switch to cheaper alternatives or reduce discretionary spending, further dampening demand for businesses. The combined effect of market volatility, reduced corporate investment, shrinking export markets, and rising consumer prices creates a feedback loop that can slow economic momentum. As businesses become more cautious and consumers more restrained, economic growth risks faltering. This environment also places strain on employment, as companies facing higher costs and reduced revenues may cut back on hiring or lay off workers. The uncertainty surrounding the tariff war discourages new job creation, exacerbating economic anxieties. In summary, the immediate impacts of the tariff war are complex and multifaceted, affecting the financial markets, corporate strategies, export-dependent industries, and everyday consumers. These effects intertwine to create a challenging environment for the American economy, with repercussions that extend far beyond the initial trade dispute and into the broader health of the nation's economic outlook. Responding effectively to the tariff war with India requires strong leadership and skillful diplomacy, as the situation presents complex economic and geopolitical challenges that cannot be resolved through unilateral actions or short-term fixes. America faces the urgent need to adopt a strategy that balances firmness in protecting domestic interests with openness to negotiation and cooperation. This approach demands a nuanced understanding of both the economic realities on the ground and the broader international dynamics at play. Leaders must craft policies that safeguard American businesses and workers from unfair trade practices while avoiding actions that could escalate tensions further or alienate key global partners. Decisive leadership starts with clearly defining national priorities and communicating them transparently to both domestic and international audiences. Policymakers must articulate the goals behind tariff measures, whether they aim to protect intellectual property, reduce trade deficits, or encourage fair competition, in a way that builds public support and reassures markets. Without this clarity, tariffs risk being perceived as arbitrary or punitive, which can undermine confidence and provoke backlash. Furthermore, leadership involves being responsive to evolving conditions, ready to adjust policies based on economic data, diplomatic developments, and feedback from affected industries. Diplomacy plays an equally vital role in resolving the conflict and laying the groundwork for sustainable trade relations. While tariffs are often wielded as leverage in negotiations, lasting solutions come through dialogue, compromise, and mutual understanding. America must engage with India constructively, recognizing India's legitimate development goals and the political realities it faces. Diplomatic efforts should focus on identifying areas of common interest, such as innovation, technology collaboration, and infrastructure development, where cooperation can build trust and offset trade frictions. Multilateral forums and trade organizations can also provide platforms for dialogue and dispute resolution, helping to manage conflicts without resorting to damaging unilateral measures. At the same time, America must strengthen its economic partnerships beyond India, diversifying trade relationships and supply chains to reduce vulnerability. Building alliances with other countries that share similar trade values and standards can help create a united front against protectionism and unfair practices. This strategy also involves investing in domestic competitiveness through innovation, workforce development, and infrastructure, ensuring that American industries remain agile and resilient in a rapidly changing global economy. By bolstering internal strengths, the U.S. can negotiate from a position of greater leverage and reduce the risk of over-reliance on any single market. Protecting domestic industries does not mean retreating into isolationism, but rather finding a balanced approach that supports growth and fair competition. Tariffs can serve as a temporary tool to address specific grievances, but they should be accompanied by broader reforms that enhance market access, improve regulatory transparency, and promote intellectual property rights. Policymakers need to work closely with industry leaders to understand the real impacts of tariffs and to design policies that minimize collateral damage while maximizing strategic benefits. Restoring confidence in trade relations is essential for stabilizing markets and encouraging investment. Clear and consistent communication from government officials, coupled with visible progress in negotiations, can help calm investor fears and reduce market volatility. Demonstrating a commitment to resolving disputes through established rules and partnerships reassures businesses and consumers alike that the economic system remains reliable. Ultimately, navigating this tariff war demands a combination of strong leadership, patient diplomacy, and strategic vision. The complexity of the issues involved means there are no easy answers, But with a thoughtful and balanced approach, America can protect its interests, rebuild constructive trade relationships, and lay the foundation for long-term economic stability and growth. Policymakers are facing a formidable challenge in navigating the complexities of the tariff war between America and India, as they must carefully balance the protection of domestic industries with the imperative to maintain vital global alliances and restore confidence in the markets. This balancing act requires a sophisticated approach that recognizes the interconnectedness of the modern economy and the delicate nature of international relations. On one hand, there is strong domestic pressure to safeguard jobs, industries, and technological leadership from what are perceived as unfair trade practices and competitive threats. On the other hand, policymakers must avoid alienating India, a key partner with which cooperation is essential not only for trade, but also for geopolitical stability, security, and broader economic collaboration. Protecting domestic industries is often the most visible and politically salient aspect of trade policy. Industries affected by tariffs demand government action to level the playing field, and elected officials respond to their constituents' concerns about job losses, declining market share, and unfair competition. Tariffs can serve as a powerful tool to provide temporary relief, encourage domestic manufacturing, and compel foreign partners to negotiate more favorable terms. However, over-reliance on protectionism carries risks, including retaliation, reduced market access, and higher costs for consumers and businesses. Policymakers must weigh these risks carefully and design measures that target specific problems without undermining broader economic growth. Maintaining global alliances is equally crucial in today's multipolar world. India's growing economic and geopolitical influence makes it a strategic partner in various domains, including counterterrorism, climate initiatives, and regional security. Alienating India through aggressive trade policies risks pushing it closer to other global powers that may not share America's interests or values. Furthermore, trade tensions with India can encourage similar protectionist moves from other countries, potentially leading to a fragmentation of the global trading system. Policymakers must therefore approach trade disputes with a view toward preserving partnerships and fostering dialogue, even when taking firm stances on contentious issues. Restoring confidence in the markets is another critical responsibility. Financial markets thrive on predictability and trust in the stability of policies and institutions. The tariff war has introduced significant uncertainty, causing volatility in stock prices, currency fluctuations, and hesitancy among investors. Policymakers need to communicate clearly and consistently, providing transparency about policy intentions and progress in negotiations. This openness helps to reduce speculation and stabilize market expectations. Additionally, demonstrating a commitment to resolving disputes through established channels such as the World Trade Organization or bilateral talks reassures investors and businesses that the situation is being managed responsibly. Policymakers must also engage closely with industry leaders, economists, and trade experts to understand the real-world impacts of tariffs and adjust policies accordingly. Trade measures that are too broad or poorly targeted can create unintended consequences, harming sectors that were not the original focus of concern. Collaborative policy design helps to mitigate such risks and ensures that measures are aligned with broader economic goals, such as innovation, competitiveness, and sustainable growth. Navigating this complex landscape requires a combination of strategic foresight, flexibility, and a willingness to engage in sustained diplomatic efforts. Policymakers must balance short-term political pressures with long-term economic interests, recognizing that trade disputes are not merely economic issues but also reflections of deeper geopolitical shifts. The ability to manage these tensions effectively will determine not only the trajectory of America's economic recovery, but also its standing as a global leader capable of shaping the future of international trade and cooperation. The current tariff war between America and India presents a critical crossroads that carries both significant risks and remarkable opportunities. While the immediate fallout has been damaging, with market volatility, disrupted trade flows, and strained diplomatic ties, the situation also offers a unique chance for America to emerge stronger, wiser, and more united if it can navigate the crisis effectively. This moment calls for resilience and strategic adaptation, qualities that have historically allowed economies and nations to rebound from shocks and chart new paths toward growth and stability. One of the key opportunities lies in the potential to reevaluate and strengthen America's economic foundations. The tariff conflict exposes vulnerabilities in supply chains and trade dependencies that have accumulated over decades. By addressing these weaknesses, the U.S. can reduce its exposure to sudden shocks and create a more resilient economic structure. This means encouraging diversification, both in sourcing and markets, so that businesses are not overly reliant on any single country or region. Greater diversification can protect American companies from future disruptions, making them more adaptable and competitive in a rapidly changing global landscape. The tariff war also highlights the importance of innovation and investment in emerging industries. As traditional trade relationships face uncertainty, the need to foster domestic innovation becomes even more urgent. Investing in technology, research and development, and workforce skills can help America maintain its competitive edge on the global stage. By focusing on industries of the future, such as clean energy, advanced manufacturing, artificial intelligence, and biotechnology, the country can create high-quality jobs and new export opportunities that are less vulnerable to trade disputes. This strategic shift can build long-term economic strength and enhance national security. Moreover, the crisis provides a powerful impetus for political and economic unity. Trade disputes often expose divisions within governments, industries, and political parties. However, they can also serve as catalysts for building consensus around common goals. In responding to the tariff war, leaders have the opportunity to rally diverse stakeholders, businesses, labor groups, policymakers, and consumers around a shared vision of economic renewal and fair trade. This unity is essential for crafting coherent policies that balance protection with openness, ensuring that the benefits of globalization are broadly shared while addressing legitimate concerns about fairness and sovereignty. Diplomatically, the situation encourages a reassessment of America's approach to international partnerships. While the tariff war has strained relations with India, it also underscores the importance of dialogue, mutual respect, and collaboration. By engaging constructively with India and other key partners, America can rebuild trust and forge new agreements that reflect the realities of the 21st century economy. This engagement can extend beyond trade to include cooperation on global challenges such as climate change, public health, and technological governance. Strengthening these ties will not only help resolve current disputes, but also build a more stable and interconnected world order. Lastly, the tariff war prompts reflection on the global trade system itself. It offers an opportunity to advocate for reforms that enhance transparency, fairness, and dispute resolution mechanisms within international trade institutions. By championing a more equitable and rules-based system, America can help shape a global economic environment that benefits all participants and reduces the likelihood of destructive trade conflicts in the future. This critical juncture thus embodies both the perils and possibilities inherent in a rapidly evolving global economy. How America responds will determine not only its immediate economic health, but also its capacity to lead and thrive in a complex and competitive world. Looking ahead, the future of America's stock market and broader economy hinges on how effectively the tariff war with India is managed and resolved, alongside the broader economic and geopolitical shifts reshaping global trade. Investors, businesses, and policymakers are closely watching developments, aware that the path forward will be shaped by a combination of strategic decisions, market responses, and international cooperation. The coming months will be critical in determining whether the recent market turmoil is a temporary setback or the start of a more prolonged period of instability and adjustment. One of the key factors influencing what comes next is the potential for de-escalation in trade tensions. If America and India can move toward a negotiated settlement, perhaps by agreeing on phased tariff rollbacks or new trade frameworks, confidence in markets could be restored relatively quickly. Such an outcome would reassure investors and businesses that stability and predictability are returning, enabling companies to resume investment and expansion plans. It could also pave the way for deeper economic cooperation, unlocking new opportunities in sectors like technology, manufacturing, and services. A cooperative approach would help mitigate the damage already done and create a foundation for sustainable growth. However, if tariffs remain in place or escalate further, the risks multiply significantly. Prolonged trade conflicts could entrench uncertainty, discourage investment, and slow economic growth. Companies facing persistent higher costs and disrupted supply chains might seek to relocate operations to other countries, resulting in job losses and reduced competitiveness at home. Consumer prices could remain elevated, dampening spending and economic momentum. In financial markets, volatility could persist, undermining investor confidence and potentially triggering broader sell-offs. The longer the dispute continues, the greater the risk that what began as a bilateral issue could spread, drawing in other trading partners and contributing to a global economic slowdown. Another important aspect shaping the future is the evolving global trade environment beyond the immediate US-India dispute. The world economy is undergoing significant transformation, driven by technological innovation, shifting geopolitical alliances, and changing economic power balances. America will need to adapt its trade policies to these new realities, balancing protection of strategic interests with engagement in multilateral trade frameworks. Strengthening alliances and pursuing new trade agreements can help offset risks from bilateral conflicts and foster a more resilient global economic system. Domestically, the focus on economic resilience and innovation will be central to future growth. Policies aimed at boosting research and development, modernizing infrastructure, and enhancing workforce skills will help American businesses compete in a more complex and competitive global market. Encouraging entrepreneurship and supporting emerging industries will also be vital for creating jobs and driving exports. These measures can help cushion the economy from external shocks and position the U.S. as a leader in the industries of the future. Financial markets themselves are likely to remain sensitive to geopolitical and economic developments. Investors will be vigilant for signals from policymakers, corporate earnings reports, and global trade negotiations that indicate shifts in risk and opportunity. Market participants may also increasingly factor in broader issues such as climate policies, technological disruptions, and social governance concerns as part of their decision-making processes. In the end, the trajectory of America's stock market and economic future depends on a complex interplay of diplomacy, policy, business strategy, and global trends. Navigating this challenging landscape will require adaptability, cooperation, and forward-looking leadership to transform current challenges into opportunities for growth and stability. Imagine waking up one morning to find the heart of the world's financial powerhouse, the American stock market, shaking, trembling, and plunging into chaos. What if I told you this upheaval isn't just a fleeting storm, but a direct fallout from a fierce economic clash thousands of miles away, sparked by a tariff war with India? This isn't just about numbers on a screen. It's about jobs, innovation, and the very future of global power. Today, we stand at a crossroads where decisions made in boardrooms and capitals will ripple through every American household. Let's unravel what's happening, why it matters, and where we go from here.